What are FX options and how to trade FX options? Foreign exchange options, or FX options, are contracts that give you the right to exchange one currency for another at a preset exchange rate at a specified moment of time in the future. There are two main types of FX options. A call option gives you the right to buy an asset. A put option gives you the right to sell an asset. Specify the amount of your investment on the right-hand side of the menu. Select the expiration time, the time when the option contract ceases to exist, by pressing the Time button. The expiration time is shown on the chart by the red solid line. Now select a strike price. A strike price is a set price of an asset at which it can be bought or sold in case the option is exercised. Strike prices are indicated in white and accompany the chart. Next to the strike prices, you can see the profitability scale. To check the potential profit for the chosen strike price, mouse over the higher button for buy positions, call options, or over the lower button for sell positions, put options. The green scale will be indicating your profit, while the red one will be showing your loss. You choose strikes manually, thus influencing the size of the price band. Choose the price direction. Click on Higher if you think that the price will go up. Click on Lower if you believe the price will go down. You may sell an option ahead of time and fix your profit or loss before the expiration time. In order to do this, press the Sell button. What are options? An option is a contract that gives you the right to buy or sell an asset at a preset price at a specified moment of time in the future. Let's take an example. Company A sells petrol. The cost price of petrol includes, among other things, the cost of raw material. In our case, it's oil. Oil prices are changing constantly, so the company decides to use an oil options contract in order to mitigate the risk of oil price increase. So how does the option contract work? For example, oil now costs $100 per barrel. Company A goes to an exchange and concludes an options contract with a broker for purchasing oil at $100 next month. The company has to pay the cost of the option contract, also called the option premium, to the broker. For the sake of the example, let's say the option premium is $10. Now, let's study two scenarios. 1 month later, the price of oil rises to $200 per barrel. As Company A has the option contract for purchasing oil at $100, it can use its option contract, exercise the option, and buy oil at the agreed price of $100, thus saving $100 per each acquired barrel. But what if the oil price drops to $50? In this case, there is no point in buying oil at the agreed price of $100 as the commodity is available at $50 on the market. In this case, the company does not exercise the option and pays only the option premium to the broker. Options trading has its specific terms. The purchase time is the time when a trader buys an option. The expiration time is the predetermined point in the future after which an option ceases to exist. The price of an option contract is called an option premium. The strike price is a target level that the opening price of an asset should go above or below for the position to close in the money. There are two main types of options: call options, calls, and put options, puts. A call option gives you the right to buy an asset. A put option gives you the right to sell an asset. Options is a popular trading instrument that has many variations. If you choose binary options trading, you should predict the asset price direction, whether the price will go up or down compared to the opening price. Digital options allow you to choose strike prices, thus managing your risks more efficiently. Foreign exchange options, or FX options, give you the right to exchange one currency for another at a preset exchange rate at a specified moment in time in the future. FX options have strike prices like digital options. On our platform, you can trade binary options, digital options, and FX options. What is a CFD? CFD stands for a contract for difference. The trader and the broker agree to exchange the difference in price of an asset at the beginning of the contract and at the end of it. Basically, using CFDs, traders buy or sell assets without actually owning them. Essentially, the trader predicts the asset price direction, and if the forecast is right, the trader earns a profit. If the forecast is wrong, the contract will result in loss for the trader. Note that it is up to the trader to decide when the position should be closed. Let's take an example. Mario would like to buy 1,000 stocks of Company A that currently cost $20 each, forecasting that they will grow in price in the future. Mario pays $20,000 to the broker for 1,000 stocks. After a period of time, as Mario predicted, the price of stocks increases. Now they cost $25. So Mario closes the contract and sells the stocks. As Mario's forecast is correct, he receives the price difference in the amount of $5,000 from the broker. But what if Mario's forecast is wrong and the stocks drop in price? In this case, Mario will have to pay the difference to the broker at the end of the contract. CFDs are available for almost any asset: oil, gas, gold, stocks, currency pairs, cryptocurrencies, etc. What is leverage? CFD trading allows traders to use an additional tool called leverage. Leverage is used by traders to borrow extra funds from brokers. Like in mathematics, leverage increases the trader's initial investment by a certain percentage, but it also puts it at risk. As leverage poses serious risks for traders, especially in periods of high volatility, it should be used with attention and caution. So, how does leverage work? Let's study two examples. John has decided to open a CFD position and invest $100 in stocks of Company A, expecting them to grow in price. John uses the 1-to-1 leverage, which means that his profit will increase by 1% if the stock price grows by 1%. So if his forecast is right, John will gain $1. Having the same amount of money, $100, Stephen decides to use the 1-to-10 leverage. In this case, if the price grows by 1%, Stephen's profit will increase by 10% and will result in $10. But what if the price goes in the wrong direction? In this case, the losses will multiply accordingly, but you'll never lose an amount larger than your original investment. On our platform, leverage is located in the right menu just below the amount settings. Note that leverage may differ depending on a broker, the type of an asset, and the time of a trading operation. We wish you a pleasant trading experience.